Rookies and newcomers in any field tend to make mistakes, and property investment is no exception. One of the most common mistakes I've seen new investors make time and time again is a lack of a solid buying strategy. Preparation is key in all aspects of life, and property investment is certainly no different. If you jump headfirst into the market without a well-defined strategy and a clear vision of your goals, you're setting yourself up for potential screw-ups. If you're concerned about making expensive errors when buying an investment property, we've designed this content specifically with you in mind. Whether you're a beginner just starting out or someone looking to refine their approach, I'm confident that you'll find our checklist, which is typically reserved for paying clients, incredibly helpful. Okay, let's start with number 1 on our checklist. Be conservative with your figures. Inspired by legendary investor Charlie Munger, the first rule of investment is to avoid losing money. When analysing a property deal, the focus should be on minimising the risk of losing money rather than getting carried away with potential profits. So, being conservative with your figures is crucial. When it comes to rental income, it's important to build in a margin of safety and not to overestimate your expected rent. Keep in mind that you're competing with other properties on the market, and even if your property is currently occupied, tenants may be lured away by lower rents elsewhere. On the cost side, it's essential to factor in unexpected expenses. As a general rule, it's wise to double the budget and triple the time for any refurbishments or maintenance works. Underestimating cost is common, and since the COVID-19 pandemic, the cost of materials and labour has significantly increased. So it's important to be prepared for unforeseen expenses and include them in your budget. Moving on to number 2 on the checklist, stress test for interest rate changes. Securing a great mortgage rate is fantastic, but it's important to consider the future. Will the Bank of England base rate increase, causing mortgage lenders to raise their rates? Even a small increase in interest rates can significantly impact your borrowing costs. A 1% increase could result in a 25% increase in borrowing costs. To account for this potential increase, factor it into your initial calculations and ensure you can absorb it. Now let's talk about number 3, versatility. When buying a property, consider its versatility. A 1-bedroom flat may not be suitable for a family, but a 3-bedroom terraced house can accommodate various tenant types. Purchasing a purpose-built house in multiple occupation (HMO) may attract high turnover tenants, while a 1-bedroom apartment in a city centre may primarily attract short-term younger renters. However, a 3-bedroom terraced house in a suburb offers more flexibility. In our opinion, a 3-bedroom terraced house is the most versatile and safest type of property. It allows you to target the majority of the tenant market at any given time, giving you an advantage in a competitive market and helping maintain high occupancy throughout your ownership journey. Moving on to number 4, plan for situations, not events. Unexpected maintenance issues can arise at any time, not just during storms or convenient moments. It's crucial to have a scalable policy for budgeting costs to avoid being caught off guard by unforeseen expenses. Consider setting aside 30% of the gross rent for costs. While it may seem high, this accounts for various expenses such as property management fees, 1 month per year for vacancy, landlord insurance, and general repairs and compliance. By allowing for costs that may not occur every month, you'll be better prepared when they do arise. Let's discuss number 5, the bottom line. The bottom line is what truly matters in the world of investment. Forget about the flashy gross yield that everyone talks about. Instead, let's dive into the real question. How much of the rent will actually end up in your pocket? That's where the net return on investment or return on cash comes into play. To help illustrate this, let's walk through an example scenario. Imagine you have £30,000 of cash in your bank account. The burning question is, how much investment profits can you reasonably expect to make with this amount? Let's crunch the numbers. You found a property with a purchase price of £106,000. It has the potential to generate a monthly rental income of £700, resulting in a gross yield of 7.9%. Exciting stuff, right? But hold on, there are other factors to consider. You need to account for the various costs associated with the purchase, such as stamp duty and legal fees, which amount to £5,180. Additionally, you'll need a cash deposit of £26,500, which corresponds to 25% of the property's value. So the total cash required for this investment is £31,680. Now let's break down the numbers further. With a monthly rent of £700 and a mortgage interest rate of 5%, your net monthly income after deducting the mortgage interest amounts to £369. Not too shabby, but remember, there are additional costs to keep in mind. We recommend setting aside 30% of the rent for monthly expenses, which in this case will be £210. This accounts for property management fees, potential vacancies, landlord's insurance, general repairs and compliance. After considering these costs, your monthly expected profit comes to £159. So what does this mean for your overall investment? Based on these figures, the estimated net ROI amounts to 6%. We calculate this by taking the monthly expected profit of £159, multiplying it by 12 12 months and dividing it by the total cash invested, £31,680. Now here's the exciting part. By focusing on the bottom line and taking into account both rental profits and capital appreciation, you can make an informed investment decision. Combining an annual rental profit of 6% with an annual capital appreciation of 6% results in a total ROI of 12% per annum. By ensuring the stability of your investment on a month-to-month basis, you'll not only ride the wave of capital appreciation over the long term, but also add it to your ROI, maximizing your returns. So when it comes to making wise investment choices, it's all about understanding the bottom line, considering both rental profits and capital appreciation, and making a well-informed decision that aligns with your financial goals. So that's it. 5 simple checklists to help you avoid rookie mistakes. If you'd like to see an example of our investment evaluator, feel free to check out the link in the description. This is our tried and tested method for buying right. We have purchased hundreds of investment properties for ourselves and our investors, and this method has consistently helped us exceed our investment aspirations while safeguarding against unexpected expenses. If you prefer not to go it alone and would like expert advice, give us a call or visit the Homesure website for more information.